and via our Bloomberg Radio Plus app, free for iPhone and Android devices.
Peter Dixon's view now. He's global equities economist at Commerce Bank in London. Good morning and welcome, Peter. More economists are now predicting the Fed will taper its stimulus from next week, especially with today's data forecast to show U.S. consumer spending increased last month. Where do you come down on this question?
Well, I mean, I've always been a 2014 guy, but it has to be said that my conviction with regard to that call has dwindled in the course of recent weeks. I think it's a 50-50 shot that we might get some form of tapering before the end of the year. But I just think that given many of the messages that we've been getting from the Fed over the course of the last few months, they're perhaps a little bit more reluctant to pull the trigger than the markets perhaps currently are pricing in. And don't forget, of course, that they completely wrong-footed this in September. That they'd have to give us a very clear signal about what they're going to do, because I don't think they want to fool us twice.
Yeah, stocks sank on Wall Street yesterday, and I take it that's largely because investors were playing catch-up on this question of whether next week's meeting is the one where we're going to get the FOMC go-ahead for tapering?
Yeah, I mean, I think that's it. I mean, you've got a combination of thinning liquidity, rising uncertainty. Investors just don't want to take any risks. They don't want to be caught out. So obviously under those circumstances, it makes sense to flatten positions as much as you can, book in as much profit as you can, because the last thing you want to do is head towards the end of the year with some red showing on your account.
Well, we've been here.
All right, let's pause it right there. Hello and welcome in from Sunnyvale, California. I'm Mark Vierra. Going to go through some technical analysis, and this is not any recommendations to buy anything. Just want to share some analysis with you. I'm going to go through some trend lines, some chart patterns, volume, throw in a little methodology and managing a trade, and call it a video. So let's get started here. Go into the charts. Throw this down here. So the first, I always like to start with a long-term time frame. Let's take a look at the monthly chart. We got a pretty bearish candle popping below this is a key resistance pivot. We popped above it, now we're below it. And I think it's an important level, bullish above and bearish below. So zoom in, take a closer look. Oh, actually I moved it up a little bit. So we're sitting kind of on, how did I do that here? Oh yeah, I think I squeezed it in to kiss this a little bit more here. So as you can see, we have subjective trend lines can be adjusted. A few degree angles here and there can really change things up. As you noticed, I did move it down a little bit. I wanted to be a little conservative. I don't want to try to overly push something to match my bias either way. So that's the reason for that. So I'm saying that is still pretty neutral. It's sitting right on top of the line, and a clear dash below that would give me a more bearish bias. Right now it's kind of a neutral looking at the monthly chart. So what else can I say about the monthly candle here? It's over halfway of the previous candle, so that's a little bit more bearish, if you want to use that as a term. Anyways, let's move on to the weekly trend lines. Here's the most important trend line I'm looking at here on, and this is sort of the same thing as the monthly, but now I have more on the weekly chart. I'm afforded more touches, and so this is just kind of zooming in, if you will, comparing the monthly to the weekly chart. Now here's a good view, and rightly so is why I moved that trend line on the monthly, because you can see on the weekly that we're still above that key pivot, and this is going to be a very important bullish above, bearish below kind of pivot. Right now it's support. If it bounces below, it most likely will become resistance. So that's what I'm looking at on the weekly chart. Well, let's get rid of that. And let's see, we have fib extensions. And let's take a look at the really impressive, these fib extensions. How you draw a fib extension is you go from a low to a high and then to the corrective phase, and then that gives you the extension, and the 100% would be the distance between here and here added to this point here, and the range went all the way up to the $1.61. This is a huge level to achieve, and of course that's where now these resistance and support, I didn't change this from last week, and this is really uncanny how respect is paid to these fib extensions as well as trend lines too. You can see that from the weekly chart that we just looked at. In any case, here's where we're going to find support. Now that we're having a bit of a pullback, I'm going to throw in a fib retracement. Okay, so we're going to go from the low to the high, and these fib numbers are going to get respect paid to them. And the further down it goes, of course, the more support it's going to find. 50% is sort of a rule of thumb for traders. Will oftentimes start initiating aggressive buys down at this level, and that happens to be the 1730. I have some chart patterns too that actually coincide with that, so let's see what else we can get into here. Close that chart. I am kind of looking at a weekly flag. There's not a whole lot of touches going on. It's kind of a high and tight. Not really a high and tight, because high and tight wouldn't have any negative downside. But I'm throwing a flag in there just to kind of see. I want to see what the measurement would be on the downside target of a flag. Now, a bull flag is a bullish pattern, but with patterns, you want to be mindful that they're not always going to follow what they're supposed to follow. Okay, so there are downside targets to bullish patterns, and there's upside targets to bearish patterns. Okay, moving along. Let's see. Take a look in order. This is how the order is going in my log. You can see all these icons I've got, and talk about getting into my trading log. So here's a nice resistance line. We got a touch here, touch here, a touch here. Lower support. This is just sort of a median, loose, kind of a very subjective pivot line that I like to throw in there just for kicks. It represents, just like fib levels, it's amazing sometimes how just this freehand line will actually turn into a key level. Now, this isn't really a very subjective line here. From the high to the high here, and keeping this thing going through here, you can see price above, below, above, below, and it's proving to be a key pivot. So this is a less subjective. I'd say this is more of an objective. And also pointing out here on the daily chart that we do have lower highs and we do have lower lows. So that's some kind of confirmation to an intermediate term top. Okay, we do have double top measurements. I'm going to get into that in the chart patterns. So I want to say that we have a semi-confirmed intermediate top. Okay, moving along. Let's see, what else can we look at here? Regression. Okay, Andrew's pitchfork. I'm going to have to end up redrawing this after we get to see what's going to happen to prices. Testing the lower channel of Andrew's pitchfork. We'll see if that breaks below that or not. Should be interesting. Now here we have our 5, 9, and 20-day moving averages. Our 5 is crossing below the longer term, and our 9-day is crossing below the longer term. This is bearish. I mean, this is just, moving averages are, of course, lagging indicators that are just confirming what's going on. Sometimes you need to have that in your mind to confirm what you should already know. And here's another look at our longer term 20, 50, and 200-day moving averages. And I've highlighted the Bollinger Band to see that we have some contraction going on here. A movement down to the lower part of the Bollinger Band. And now we're going to see, I believe, the Bollinger Band should start expanding out as volume or supply may enter the market. We'll get into more of that in volume. So the other thing to note here is below the 50-day moving average might be a good reversal spot. If we break below the 50-day moving average, I'll start throwing in what I like, the 100 and 120-day moving average. I don't have it in this chart, but we'll see. If we get more bearish activity, I'll throw that one in there, because that has, over a period of time, been excellent reversal spots. And not saying that the moving averages are causing the reversal spots, but it's a good just to landmark where previous price has reversed. Okay, let's see, what else do we have here? We're into fibs. Daily fib. Let's take a look at the daily fib. Alright, so our retracement, this is a longer term. I'm going down to this low. This was a pretty defined low spot, and we had some corrective phases in here. But I just wanted to see what the fib retracement would be from the major low to the intermediate term top that we have put in here. And you can see that we're getting respect paid to the 23%. And there's that 1729 in there again. So that's pretty much the same thing as the weekly fib, actually. Now, from the beginning of the year, we could look at the 23% down at the 1716 for major support. So Fibonacci numbers are really amazing, that how price interacts with these levels. So now we're going to get into some, I think patterns are fun to look at. Okay, you don't want to put too much stock in patterns, but some patterns work better than others. And individual names may work differently. I don't want to say better or worse than indexes, but some patterns work differently, and especially in Forex, certain patterns have different odds, I want to say. And so studying patterns, I think, is just kind of a really fun thing to do. The psychology behind the pattern, and it's good to use volume as my favorite to confirm whether a pattern is doing what it's supposed to do, or whether it might be just a big fake out. You know, the market operators love to do false breaks out of these patterns all the time. Happens all the time. Here I'm showing we had a double top. The previous pattern chart, we had this round top. We got kind of another rounding top going on here, and we did kind of a measured move, corrective phase, and then moved lower. And now this is really kind of a loose bear pennant. We want to see if we get some more action, sideways action. It'll become more of a defined bear pennant. We'll see if that breaks below. Now here I wrote double top confirmation break. What that means is, well, we'll get into I got measurements on the double top. So let's see what we got here. Broke down out of the rising wedge. Here's that 1728. That's if we go back to our fib, levels, that's a key target, and that's happens to be the rising wedge target. This is a busted pattern. We were looking at a head, left shoulder, right shoulder. Now the right shoulder is about the same distance as the head, so that's not a pattern. I noticed on the Dow Jones, it's kinda, but then the left shoulder on the Dow isn't very defined. So no head and shoulders pattern going on, but we can call this a double top now, because we have a confirmation below the valley. So in measuring this thing, you want to go from the subtract from the peak to the valley, and your equidistance would be 1751 as a target. More conservative of a target, however, would be the 1760. So that's the first target I'll be looking for. And this line here is our confirmation. So we can say the pattern is in play. It'd also be a good resistance line too. We should see resistance from that. So pattern targets. Okay, here we're going to get into some volume, and we did a pivot below this high volume node. And I mentioned last week how we pivoted above. So what do we do here? Let's take a look. Back here we did a pivot above that high volume node. Here below that high volume, back above, and now back below. So that is really a key high volume node pivot that now will become stiff resistance. Also, I've got this line drawn here, so we have a confluence of pivot lines. So pretty well confident that that is a very key level. We should see support on the point of control. This is a 3-month point of control, which has moved up from this value area and these high volume nodes down here. I'm leaning bearish, and get into the market profiles if I can really, get into my rationale there. But I'm looking at basically you're getting a decline of volume. We want to talk about market elasticity and how price affects supply and demand. So let's take a look at an hourly. Okay, this gives us more of a define. Got a little bit of hidden bearish divergence. On the near term, you can see a sharp decline in volume, and this is interest. So less interest is being paid attention to at this lower price. Okay, that's what I mean by elasticity. Okay, how does price affect supply and demand? So what I wrote here, declining volume, no indication of strength in the move lower. Okay, I find that to be bearish. All right. So now we look at our market profiles. This is expanded monkey bars. I'm going to look at both monkey bars and expanded monkey bars. And what I'm seeing here is from this playground here to this playground, we had a little bit of a gap. Okay. I'm going to talk about accelerated speed of price too here in a minute. But I marked this way back here, this high volume node. This is that pivot that I was talking about. And you can see it a little more clearly now on the profile on how price just up and down, just pivot above and below that price. You can kind of think of that as distribution, where you have the market operators, they want to take out stops in both directions. And really, the job of the market is to drive out speculation. So you got speculation that is long, and you've got speculation that is short, and the market is very good at getting rid of what we call the looser hands that's going on there. All right, and this is how they do it. They mark price up and down. They can manipulate the supply and on the near term to adjust prices, and we call these tests of supply and tests of demand. And then we'll look at volume spread analysis too to confirm on what's behind the scenes in there. So let's get a little bit. What I'm looking at now is you can see these past few days of below the playground area, and on this lower volume, that is also more confirmation of a lack of interest at that price. And to me, I'm calling that a bearishness. And here is 10-day hourly chart, I'm going to shrink myself down, and we can see the acceleration down here, this huge gap in the playground. We're getting conviction to the downside, and now here's our highest volume node, and I think this is likely going to turn into a point of control, another pivot. I think we're going to see more consolidation. But what I really want to point out, though, is that without interest at this lower consolidation, I think is bearish. I think we're going to see lower prices until the market becomes elastic and gets interested in these lower prices. So what I'm looking for is any kind of spikes on volume. You might look at that as some beginning of climaxing, and that's basically what I'm trying to say here, is that there is really no sign of any kind of climax going on. So now here's the last market profile, and I want to point out is these vertical squares. Okay, these are your playgrounds. This is 70% of the trading activity. Of course, I've mentioned this in previous videos, so I don't always explain everything in every video. So you should already know that this playground is 70% of the trading activity. This is a vertical playground. What that means is this is speed of price. Okay, you have where the market has speeds. It goes fast, it slows down, it goes fast, and it slows down. Going fast is great because you know eventually it's going to slow down. So you wait for the market to slow down, and you know you're going to get consolidation. Almost always, you know, when you see a vertical profile like this, you know the market is accelerating its speed, and usually that means the market wants to take stops out, and that there is going to be a reversal. You know, you don't know when it's going to be, but you can judge from now, if you look back here at this playground, how this is just a square, and then you know you can tell by the shapes of these playgrounds on how the speed of price and when it's slowing down, and we can see it's slowing down in this, you know, a bit here, and of course we opened here, we closed up here, and then we opened up at about the same price as the closing from the previous, and dropped below the TPO. This is the monkey bar, and price settling down here, and we can see the decline in interest at that price is what the main things that I'm pointing out, and is why I'm mainly bearish on the market. Is I mentioned in the last video that we're going to see consolidation after a move higher. I'm going to be looking at volume. If I see about the same amount of volume or an increased amount of volume, then I'm going to believe in the higher prices more than what I'm seeing now is the decline in volume. Even though the market is in a consolidation mode, I find it bearish that just lack of interest in buying at that price. So, and then there's not, supply hasn't really come charging into the market either. So, but I'm expecting, I believe, we're going to see some supply entering the market soon, and that's what I'm predicting. Now, I don't know if I mentioned, I'm making no recommendations to buy or sell. This is my thoughts on technical analysis, and you know, take it for what it is. It's not any, you know, buy this or, you know, I'm not trying to sell you anything. All right. Let's look at treasuries. I like to look at risk. Yeah, I could look at the VIX too. The VIX is going up. Big deal. All right. U.S. treasuries, I'm getting more and more bearish. Last week I said we were going to hit the point of control. We did. I think we've seen a 6-month daily. Okay, 3-month daily was last week's chart. But we're right at the 6-month daily point of control. I'm seeing a descending wedge. I got a head and shoulders in the background. Declining volume. Everything I'm looking at here is looking bearish for treasuries. I think we are going to see weaker treasuries. It seems that risk asset classes are changing a bit, and I think they're forgetting about treasuries due to this Fed tapering and less demand for treasuries. I've seen a lot more strength entering in the markets for the U.S. dollar as a safe haven, along with it's not just the dollar. I'd say sterling is probably a good place where scared money is parking right now. So it's not just the U.S. dollar. The other thing here is we see some upthrust candles on the yield. This is a TYX 30-year yield. Treasuries decline, we will see a higher yield. That's not going to be great for stocks. That might be a lot of the reason why we're seeing kind of a sleepy, supply and demand going on. U.S. dollar, symmetrical triangle. I am neutral on the dollar. I think there are various fundamental reasons why the dollar should be weaker, but then in a currency war, you have central bank portfolio managers propping up the U.S. dollar. They can't afford, not to saturate their portfolios with the U.S. dollar, lest their exports suffer. So it's a really convoluted mess that currencies are in. But looking at a symmetrical triangle, I think the U.S. dollar will remain stable. I don't think we're going to get too much of a weaker dollar. So we're probably going to see a lot of divergence from inverse correlation between the U.S. dollar and stocks, where I think they'll probably correlate positive, here and there. That's always something I'm paying attention to anyway. What else? Okay, the euro now. I did get enticed, maybe a bit early, to get into my euro short, because I'm seeing, there's some bullishness. I see increase in volume at the week ending, a little profit taking going on, but not much. I am seeing some divergence in here. I think the euro just may firm a bit, but then now we get up into this $1.38 and just really lack of demand going on at that price. So we'll have to see. I might get a chance to enter in some more lots. Here's what I'm doing with my euro short, just to give you a little managing a trade kind of methodology. These are my entry spots, and I have orders up here. 6 is my max risk. I don't want to do anything more than that. Currently, right now, this is my average price, $137.60. Now, since I think the euro can climb a little bit, I'm looking at, this is my least profitable. This little entry right here is my least profitable lot. Now, I'll be looking to see if I can get a few pips profit out of that. I will cover that. I'll close that lot. And what that will do is that will give me a better average price for 1. And it'll take some risk off the table for 2. So now, if I'm right, in a little luck, I'll be able to re-enter that lot at a higher price and get better position going on. So I'm not saying short the euro, okay? I don't want to make any recommendations. I'm just telling you this is how to manage your risk, manage a trade. Just giving you a little example out there. So let's start winding this up. I want to tell you about HotStockMarket.com. This is me, Vario. This is where you can find me hanging out. Educational section in here. There are no dumb questions. You want to check that out if you want to learn more about what I'm talking about. This is an excellent place to find information, as well as I want to mention subreddit StockMarket. This is a great source of information. So that's all I got for this week. Have a good week, traders, and don't forget to check out HotStockMarket.com, and I'll see you on the boards.